Hey guys, Jay here. This is smarthelping.com. I got a brand new financial model for you. We're talking about the junk removal service business. And I know I said I was trying to do more templates, so here you go. Definitely happy to do this. I think the last one was finished, last week or a week and a half ago. So we're really getting our pace up, which I love. Um, so this is a 10-year model. And the way I like to start is I'm going to go quickly through each tab so you can see the whole model, and then I'll start in with each of the actual tabs to show you how it works. So global control is just some high-level assumptions. Executive summary is high-level financial overview, some visuals, some investor and owner, operator, project returns. Sources and uses, ramping. This is the you'll spend the most time here probably. OPEX, full-time employees, operating loans, cap table, startup costs, terminal value. And these startup costs are just other one-time costs, not accounted for elsewhere. Monthly detail, annual detail, discounted cash flow analysis, visuals, income statement, monthly and annual, balance sheet, monthly and annual, and cash flow statement, monthly and annual. And then depreciation schedule in the end there. Um, all right, so uh, I really was looking to do something without a matrix tab for the revenue assumptions because I've had to use that for like the last 10 models, and it's been necessary. The models to make the model the best it could possibly be, that was required. For this one, it wasn't required, and I was happy that I could do something more straightforward, but it still allows for a lot of sensitivity analysis. You can play with a lot of assumptions, a lot of pricing, cost stuff to see what ramping up, um, this looks like in the junk removal service. Okay, so what is a junk removal service? Well, it could all kinds of things. It could be, cleaning out a hoarder's house. It could be removing a single piece of a single item for somebody. There's all kinds of service lines you can do, and you'll see how I did the revenue assumptions here shortly. But that's as simple as it gets. Is removing junk from people's or commercial properties and disposing of it. Okay, so global control tab here. We just got your company name. Pick the length of the forecast period up to 10 years or 120 months. And whatever you select here, it'll just stop the forecast. So if I put 60 months here, you can see now in the executive summary, we only see 5 years of data. Put it back to 120. Include terminal value, yes or no. And if you do, you can do a multiple of EBITDA. And that'll give you an exit value on the exit month. First forecast month, this is just display purpose. You'll see it on like the income statement up here, but nothing's tied to this at all. Um, then we have cash sources. This is all configured elsewhere. It's just displayed here, and some tax data, and then check summaries to make sure every statement balances with everything else, and all like this three-statement model matches the cash flow from the monthly detail, and so forth. Okay, so the main place you're going to probably be is the ramping tab. And on this, I do have a high-level financial summary right beside it, so you can see, like, let's say I change something here, you can see all the numbers will change here. If I change, one of the biggest things here is pricing. For example, let's say your average base price per job is, instead of $420, say it's 400, and watch how this affects the IRR. So here it's 45.9. Let's say we lower this to $400. A full 10% change in IRR, which is big over a 10-year period. So this model, the way it's currently configured, is very sensitive to your average price per job. Um, but the setup here, so I decided to do one level of logic to get to your job count, and that's 4 lead sources. So you've got all your lead sources. They have a conversion rate right here. Each one could be different because obviously like local SEO might have a higher conversion rate than paid search. Referrals might have a much higher conversion rate than both of those, and partnerships could have an even higher conversion rate. And so you can configure the count of new leads each month, and I just did this so you can do the first 2 years manually, so you can account for like your ramp up, and then after year 2, you can define how much each grows per year. So here, I just did 20% for each of them, and what that means, and it's going to take into account if let's in year 2 we had 125 in month 1 for year 2. So now in month 1 of year 3 we do 20% more of that. In month 2 of year 2 we did 300. So now we're going to do 20% of that. So you get a little seasonality if you want to go with this layout where essentially year 2 is going to be your set year, where you define how you're kind of stabilized as far as seasonality goes, and then you grow from there on 20% year over year accordingly. Now you can easily override all these. You could manually input how many leads you're getting by each source through the 10 years, however you want to do it. I just did this because to me it seemed like a decent way to forecast, especially if you have some real data you could put in here. So that's going to drive how many leads you're getting. This is going to drive of those leads what percentage of them are actually converting into real paid jobs. Now, of those paid jobs, you then can define, well, what are you making on average price per job? Now, this is where you really need some data. So like, let's say you did 100 jobs over the course of 2 months. So you want to know, of those 100 jobs, how much money did you make? Let's say it was 25,000. I'm just making up numbers here, over 100 jobs. Okay, so average price per job is this number divided by 100. So here in this case, it'd be $250. So it's really easy. If you have the data, the number's easy to come up with, and you can plug it in. If you don't have your own data, you're going to have to research and figure out what number makes sense or what range of pricing makes sense, because obviously this is going to have a major impact on the whole entire financial picture, as we saw with the IRR adjustment there. The second part is you can do add-ons. So let's say on average, you might want to say, this could be recycling value or the gross profit from recycling, or what have you, just anything beyond the average base price that you're charging. It's just there to account for a separate line item in the income statement. So you can see here, we've got base job revenue, and then we got add-on revenue here. Now it could get far more complex. I'm not saying this is perfect. This is a high level to just plug in some assumptions and data and see what the numbers look like. If you want something that's specific for your situation and you want to change it, I'm obviously available for custom work at $275 an hour. If you want to go that route, we can do that. You could use the space template, and I can modify it as you need. But anyway, so those are the two revenue drivers. You can also define the average change in price over time. So that's just accounting for inflation or price increases. I usually just do an annual rate. So this just says, in year 9, if you're starting at 400, in year 9, you'll probably be a little bit higher than that. So this percentage defines how much higher you would be. And you can see here, like, let's just look at year 4. You're at 7.4 million in revenue. If I didn't grow the price at all, the average price, then we're at 6.8. And actually, looks like we're not even profitable or getting a positive return. So in this case, the 2.5% plays a big role in overall economics. We have some more things here. So average job hours per job. So what this means is, if it takes 2 laborers 3 hours to do a job, that's 6 job hours. So we're just trying to figure out how many man hours does it take on average per job. And we need to know that because we're going to back into the count of laborers based on the average job hours per laborer per month. So this says, let's say the average job is 6 man hours. An average laborer will do 120 of those man hours or job hours a month. So then we can do a division problem to figure out how many laborers there actually are in order to accomplish that. And this way kind of gives you a good, and then we're going to just back into a fully loaded wage or salary per laborer rather than trying to figure out what you're paying them per job. That's kind of a little clunky. This is smoother, in my opinion. Because there's also like there's going to be hours where your employees are not directly working on a job. So we're trying to say, well, when they are specifically only working a job, this is the amount of hours it takes, and it could be multiple people. Again, you want to count that the total hours from everybody during the job, and then you just say on average in a month, how many hours is the laborer able to do? And that's how you back into how many you're going to need. So let's say in a given month you did 500 job hours. Well, if you did that many job hours, and each laborer can do 120, that means, and I think I rounded up, I believe, so that would be 5. I'd account for 5 laborers in that case, not 4, not 4.1. I do believe I rounded up here in this model. Let me double check. Yep, I did round up. So you can see in the pro forma here, we've got a line for total job hours required, which is just based on the total jobs against that number in J14 on the ramping. And then we do a division problem to figure out how many laborers we need, and then we're going to multiply that by the salary, which we define on the OPEX tab here in row 118. So here we're just saying 60,000 a year. So if you take 60,000 a year divided by 12, that's 5,000. And note this is fully loaded wages, so that includes any benefits, payroll taxes, and all that stuff. So 5,000 a month times how many did we have here? Let's just pick month 5. We had 1, so it's $5,000 for the month, and that's why we see that amount here. Then when we go up to 3, we're at 15, and so forth. And then in year 2, I believe I raised the count a little bit. So here we are already up to 5,000 job hours a month. That's pretty fast ramp. 42 laborers. That's 218,000 in wages. If you divide that by this, you're looking at 5,200, which is, you can see in year 2, I raised the wages a little bit. So if you divide this by 2, by 12, that's that 5208 we just calculated. So that's how we're calculating wages and labor count, which is a direct cost. Okay, then we also have jobs per month per truck. So you might be leasing the trucks, you might be buying the trucks. Either way, there's going to be costs and dynamics, and the model allows you to select if you want to purchase or lease. If you're purchasing, it's going to be all cash purchases. If you're leasing, then no money's going out for cash, but then you'll probably have a lease cost here, and this is an annual cost you'll put in. If you do buy it, then you also have some other costs like maintenance, insurance, and all that. It might be a different number, or it is going to be a different number. Probably less than if you're leasing because that you're purchasing. Sorry, less if you're purchasing because you're buying the vehicle. Or if you're leasing, then this number is going to be higher per month, but you don't have the initial capex. So anyway, this says on average how many jobs can you do with one truck, or essentially for every truck, what's the capacity of a truck, and that's going to drive your direct costs for all the trucks. So we have a calculation here: trucks added per month, truck count, and note so this you can see here. If we go down a month because of the seasonality, we do on average less jobs, so we need less trucks. The model is still going to assume we're not going to reduce the amount of trucks we have. We're just going to say, okay, we're going to maintain at this point it'd be 30. So if you look here, the actual trucks added are not changing. And so if we just sum up this is a little bit tricky to do, but if you sum up this, you can see here we're at 30, and then we don't change when we go down, and then we only change as soon as we break that 30 threshold. So here, okay, in month 15, we need 31, so we're going to have to buy another one, and so forth. And you see by those up to 34, and then in month 18, we actually went down a little bit because of the seasonality, but we're not selling the trucks or getting rid of them. We still have them. Then in year 21, okay, now our jobs ramped up to the point where we have to buy 3 more, so now we have 37. So you see the sum of those equals this total. So there's a little bit of logic here. it's just a double max formula to figure out, make sure we don't go negative, and we're only adding to our low, essentially high watermark base is what they call it in hedge funds. But as soon as you go up to a truck count, you're going to stay at that or go higher, which makes sense for a ramping model like this. Okay, so that's how that works. We have other direct costs per job. So this could be, costs on average what you're paying to dispose of things or what have you. And again, the way to calculate, you figure out over a time period how much you spend on those types of costs divided by the job count, and then that's the number you put in here. There's also an annual cost growth, again, for inflation, that you can define there. Um, we also have so this could be a franchise that you're starting or buying into, meaning you're going to have initial upfront franchise fee, to get the name brand and all the IP and everything related to the brand. You could benefit from that. But if you do, you're going to be paying royalty fees, most likely, and possibly marketing and brand fund fees. And that's going to be applied to gross revenue. So here, I have it at 0. Um, and those numbers will come in right here. And right now I just have, that's just the marketing. If I were to add 5% here, you can see this row is going to go up a lot. So here, yeah, quite a bit. And that lowered our IRR down from 35 to 18. So it's a necessary thing if you're going to, obviously it's going to play a big part in how many jobs you get compared to if you're just a no-name startup with no brand versus a name brand, a national brand that people know, you're going to have more jobs. So those are all things you want to consider when you're doing this, or thinking about starting this kind of business. Okay, so those are the royalty brand fee. We can decide to purchase or lease trucks. So if I purchase, you can see here in the monthly detail our capex is going to be much higher. So truck purchases right here. Based on our job demand and all of that, we're going to figure out how many trucks we have to buy each month. So way higher capital requirement. You can see here min cash required is at 2.3 million. If instead I'm going to lease the trucks, you can see now our cash requirement went way down to 75,000. Now that could change. So let's say we're leasing, so maybe our annual cost per truck, it's probably not 5,000. It could be like 36,000, or higher. So if I were to just plug this into each year, now you can see the capital requirements are going to go up a bit because we do have burn now. It actually wasn't feasible if you're leasing. And that's, look, you don't have any of the capex anymore, but your truck costs, if we go up here to direct costs, we have no depreciation, obviously, because we're not buying them, but we have this here. So this is just blowing up our P&L. The cost per truck for lease or maintenance is causing, this extra 500,000 here. We're barely profitable, $100,000 in gross profit in year 10 of the final month, and we don't have enough to cover, so we're actually operating at a loss. And then you have debt service there, so yeah, it's just not feasible. And again, I've made up these numbers. This is not like a real scenario. I'm just showing you what happens when you change certain variables. So maybe it works at 25,000, or maybe you have to raise your prices or adjust other things. But here, I'm sure that would be better. Let's look at the annual. Still negative. Still negative. Maybe we'd have to raise our prices. Let's go to like 450. Okay, way more than we need actually. Let's try 425. There we go. So just that number makes sense. And that's what you'll do is you're trying to figure out what makes what's feasible. Is you want to use as conservative as estimates as possible for all your assumptions, but you don't want to be overly conservative so that to the point where it doesn't even make sense. So, but you do want to be conservative as you can with everything and still have something that looks profitable. And in that case, you can say, well, worst case scenario, if everything's like lowest demand as we have, prices are lower, costs are higher, and even in those scenarios, we're still profitable. If that's the case, that's a good thing. And then you just optimize over time. But this is very important to research the data, because if you're putting in random numbers, it means nothing. If you're really putting a lot of work into what figures you're entering here, then your model is going to hold weight, and you can back it up with real data and say, look, this is why this is this and that. This is why we can do this much volume and so forth, and how all this will flow together with cash flow and raising money and all that, and investor returns. So you can do all that with this model. Okay, so that's purchasing and leasing the trucks. Amortization, if obviously these are direct costs and non-cash direct cost amortized over a useful life. And again, that's just added back to cash flow, and then the actual cash flow that comes out is the purchases. If you're leasing, this has no effect, and all that will really be relevant is what hits here in this row. Now I'm going to put this back to 5,000, whatever it was at, and then change this back to purchase, just because that's how it was. But again, these numbers, this is all arbitrary. I'm just showing you how the model works, so when you come in and use it, you have a good idea. Then we have our initial franchise fee. This is just you paying for the right to use the national brand if you're going to buy into a franchise. So that's a one-time initial cost, and then that's also amortized over time. That's not like a direct expense. So we're just going to amortize that, and that'll be another direct cost that's cash flow hits immediately, but the recognized expense happened over time. Okay, OpEx. So we have some corporate overhead you can account for here. Fixed expenses, you can define the start month, the annualized cost, and then how that changes over time. Again, I did this. You see these cells are white because you can adjust. They'll change as you change this percentage. But then I also have some hard-coded ones if you don't want to use that and just manually put in what your annualized expected costs are for these different items. So you've got sales and marketing and G&A and R&D. A lot of slots for fixed costs. Then we've had a catch-all here. This just applies to total monthly revenue, and it's just a percentage of that, and you can label these whatever you need to, and that cost will hit. Then we have average cost per paid lead. So this applies to, on the ramping tab, column D, column E, the amount of paid search leads you're getting each month. And so whatever your cost is here, in the given year will apply to that. We talked about loaded wages, fully loaded wages for laborers, annual cost per truck, and then also fuel cost per truck, which I'm pretty sure in any scenario you're going to be paying for that, whether you're buying or leasing. So you want to account for that because your people have to drive around, and that's going to take gas. Also, we have full-time employees. So this might not be super relevant, but I just kept it in here because the logic existed. And what I built this off of. So you can do a start month, the count, annualized salary, adjustable salary per year. Here's the annual amount, and then you can do payroll and tax benefits separately, which you can see that all happens down here in staff, and then the calculation here is taking into account the payroll tax and benefits as well. Loan 1 and 2 are just operating loans. These can cover your initial burn. It's just a simple, regular principal and interest repayment loan. You can put the amount, the term, interest rate, the month you draw on it, and that's just going to affect cash flow accordingly. They'll automatically be repaid on exit if you select to include the terminal value. Cap table, again, this is really simple. We're just at the top here figuring out what's the minimum equity required based on all the different assumptions. So if you're in the monthly detail here, we're looking at all the cash effects over time, and we're figuring out what's our minimum cash position based on all of these the timing of all these things. And you'll see that calculated there as the minimum equity, and you're just going to want to make sure in column C, the total you enter here plus the total here in both sections equals this total. I do have a catch-all in row 30 that will catch anything not entered. So here, if I just put 50,000 for founder 1, well, if the minimum equity is 1.3 million. That means you're going to need to raise 1.2 million. So you could manually define each of these, or you could just use the catch-all, or however you want. But main thing is make sure that the total of the top section plus the bottom section should always equal this, and it will if you just use the overflow. Also, percentage of the company, essentially how much you're going to give away to investors. You put that percentage right here, and the total of this column plus this column should always equal 100%, and your check calculations right here. 99% of people are not going to use this, but you can if you want. It's just a way to add. Maybe some investors are in a different class, class A, class B, with different percentages. You can define how much of your shares are in those if you want here, and then how much of each percentage is owned within a given class, and that'll all calculate here to get to your final fully diluted share count and percentage ownership, which you'll be able to see cash flows and IRRs for each of these rows over here in the IRR. Startup costs, again, this is just going to hit in period 0, just an expense like consulting, legal, just one-time other fees that you haven't accounted for anywhere else. Non-CapEx stuff here, this is stuff that's not depreciated. Terminal value, so of the vans or trucks, you might call it, we got a book value. It's a percentage of the book value you think you're going to get on exit, and then so that's to account for the fixed assets that you have on exit plus the value of the business itself. Monthly detail. So here, we got 10 years of potential data, depending on how long you want to do the forecast for and enter. We've got our leads, the amount of jobs we're getting from those leads, the booked revenue, add-on revenue. We have some KPIs here, average revenue per lead, which is good to know if you're paying more per lead than what you're making per lead, though that's probably not a good thing. Direct variable costs. So we kind of went over some of this already. You've got your total job hours, labor head count, labor costs, truck count, truck costs, fuel costs, other costs per job, and then just a summary of these variable direct costs here. Gross profit, then we have our fixed costs here going down, and then we have EBITDA and EBIT. Remember, EBITDA is not taking into account depreciation. These two items in fixed costs are depreciation items, which means it's non-cash. The actual cash that happens will happen down here in truck purchases, and then your initial franchise fee. So that happens there. So we don't want, in EBITDA, we don't count those two because EBITDA is kind of like what you're making in cash every month, actual cash flow. Now EBIT is going to take into account those depreciation items, so this will be a little bit less. Then we have other items here, our loan proceeds, debt service coverage ratio, which is just how many times your EBITDA can go into the debt service coverage. So how much money essentially you have to cover your debt service. It's an important number for banks. Then we've got our other items here, CapEx, taxes if you're profitable based on the tax rate, and then exit proceeds on exit, whatever that might be based on your multiple. And then cash flow, running cash flow, another KPI down here, average monthly EBITDA per truck. Annual detail, same thing as the monthly, but on an annual basis. Discounted cash flow analysis, this just looks at the minimum cash required and then does an algorithm here to actually make sure the correct amount of cash flow is coming in or out based on the monthly cash flows. And this always, if you sum this up, you see this equals 20,132,000. That will always equal your cumulative cash flow of the whole project, 2132. It's just front loading. It's saying all the cash you need to cover all the burn, the capex, everything else while you're getting stabilized. It happens up front, and then any positive cash flows, if available, are used to cover any negative cash flows, like this is happening here in year 2. Basically meaning you're using some of these positive cash flows to cover this burn without having to raise any more money, and then eventually go positive here. And then you can see the project's IRR and just net present value. And you can also look at the investor pool as a group and the owner pool as a group. We have visualizations, total revenue with the nice little labels here with the $.million, which is clean and nice to see. Gross profit not including depreciation. EBITDA, gross profit percentage, cash flow, average lead conversion rate. And again, this is going up and down because I just put in an arbitrary seasonality here. So you can see that displayed in the visuals. EBITDA percentage, annual capex. So this is mainly buying the trucks as you ramp up. Total assets versus liabilities, average monthly EBITDA per truck, total assets versus liabilities annual view, monthly cumulative cash flow. This is good to see break even, essentially when you've paid back your investment in the project is when this goes past zero. And then average revenue per lead. Then don't forget we have our connected three-statement model. So this is more of the accounting side, but we have our income statement. We have our income statement annual. We have our balance sheet all balanced out through the whole thing, and this always stays balanced. It should, as long as your assumptions are logical, and there's really not an easy way to break this. So as long as you're just editing the cells in yellow, this should all always stay balanced. And the cash flow statement here. Now, one thing I've started to add to these industry-specific models is the sources and uses. So this is, and you could get even more complex, but I kind of broke it into essentially equity, debt, and then any net operating income that's positive that you're using to cover burn. So that's here. These three are your sources of cash. And the reason why it's important is because it's not just all up front. You know, definitely depending on how your expenses go and how you're ramping, you could have burn in the first few months or even years, and you need cash to cover that burn. Now, you could also have positive cash flows that you're using to help pay for some of the other things, like different capex. So in this case, we actually have some positive operating income, and we're using that to cover, and that's this right here. So until we're in this model, based on just the random numbers I put in, month 22 is when we actually get stabilized. So here we're actually making positive EBITDA from month 10 to 22. So it's going to count the net effect of all your EBITDA from month 1 to whatever that month is, which in this case is 235,000. And that's dynamically going to come in and hit here. Now, it could also be net negative. Let's say you have burn, and from month 1 to 22, you actually have a net negative operational cash flow. Well, that's going to then be a use, essentially, and means you're going to have some funds to cover that. Now, in this case, up to month 122, we're actually positive. So we're using those cash flows from the business to pay for other things, as well as these loan proceeds and equity. And that's covering your uses, in this case, the franchise fee, the truck purchases, other initial costs, debt service, taxes, and then you can see these match. This should always update as you update all the assumptions. For example, you see truck purchase here at 2.1, equity at 1.3. Let's say we made the purchases only 50,000. Well, now you can see our equity dropped down to 1.1 here. Truck purchase is down 1.950. So it changed. Dynamically, you can see the percentages. Now, if you wanted to, you could basically use the same, let's see, it's this formula, sum ifs, and you could target your monthly detail if you wanted to actually see within the operational cash flow. Like maybe you want to see what's the gross profit, and then you might want to see, what different fixed cost items are making you, or maybe royalty fees are a part of any negative burn, or what gross profit is being used to cover the costs. So you could just apply that logic, the sum ifs here in each of these sections, to different rows within the monthly detail to see, up to month 22, which is when you're making positive cash flows, what is going into that. Alrighty, well, I think I've talked through the whole model. If you want to download it, you can get it over at smarthelping.com. We'll go over here now. So it'll be in the general industry models, and you'll be able to buy it either within the whole bundle for $2.99 or individually. I think I'll list this at probably $75. And section, let's see, probably under services. So it'll be in the services section. I'll also include it in the services bundle. It'll be in the industry specific bundle, and then obviously it'll be in the Super Smart bundle, which includes all the models on the entire site. So there's multiple ways to purchase. Depending on what you're looking for, you could just buy the single template when I list it, which I'll be listing that today here in the services section of the industry specific page, which you can find. It's right here in the sidebar, or if you go to the home page, it's the first one up top. You can also check out more financial models. I do this for a living. I've built all kinds of startup models like this, bunch of different businesses. I've done a lot of SaaS work, real estate underwriting, just general joint venture waterfalls, general business valuation. The exit readiness planner I did in here is really awesome, I think, for any small business. Accounting templates, HR management tools, general Google Sheet stuff. So check it out. You can hire me, $275 an hour. Remember, I do have the PayPal option now that allows for installment payments if you want to do that rather than pay it all up front. Pretty quick turnarounds, 1 to 2 days usually. Jobs tend to be 3 to 5 hours to start. One-off jobs are usually under 5. Obviously, ongoing work is whatever it is, depends on what you need and how much we work together. Typically, a common path ongoing clients will do is they'll just buy the Super Smart bundle, which is all access to all the templates, and then hire me for work. And then they never have to buy a template again, and they have access to everything I ever build in the future that's put into this. And then if I need to pull from it, I will. If not, I won't, and you just pay me to do custom work in general. So that's a common path I see with clients. Alrighty. Well, like and subscribe. That's all I got for you, and I'll see you on the next one. See if we can keep ramping up these templates.